Hi, I'm Shae Russell from Fat Tail Media, and joining me today is Rick Rule from Sprott. Rick, how are you this morning, or the afternoon, actually, over there in Vancouver, isn't it?
I'll answer to both, Shae, and I'm doing fine. I'm delighted to be back on with you.
Now, it is fabulous to see you once again. But before we get into our topics today, and we have a lot we want to cover on the commodities market, I want to just go back to a comment that you personally left on one of our videos that we've done over the past few months. And somebody commented that you look like you've lost weight and you look very handsome today. Now, I would just like to add that you do look very handsome today.
Flattery will get you everywhere. About the video quality, of course, but.
All right, so flattery out of the way, I want to kick off with sort of, proving that what we were talking about a few months ago was right. Now, a couple of months ago, we were actually talking about how overbought some of the gold stocks looked. And, we were talking about this as gold stocks and gold were in the middle of one heck of a rally. And there has been a considerable sell-off in the gold sector. Tell me, what does this correction actually mean? And is now the time to buy, or should we ease back on the trigger finger and wait for another opportunity, or is now the opportunity?
Well, I think there's three things to point out. The first is remembering the comments section in that video. When you disturb people's paradigm, you're very unpopular, and your readers didn't like that. They need to understand that pullbacks like the one that we have just been through are completely normal and natural. Cyclical declines in secular bull markets are a feature of secular bull markets. And as we talked about at the time, a 15 to 20% decline in the gold equities, cyclical decline in a secular bull market is as normal and easy as inhaling and exhaling is for you and I. So nothing particular has happened, really. At the end of this bull market, when we look back at this decline on a chart, you almost won't be able to see it. It'll be a non-event. I realize it's traumatic to go through. But the truth is, if you like the space and the index itself is 25% cheaper, arithmetically, it's precisely 25% more attractive after the decline. And what I particularly like about this decline, from my personal point of view, has been, to paraphrase the movie, the good, the bad, and the ugly all declined with seemingly equal rapidity. The idea that some companies that I wanted to buy are now 30 to 35% off in price, from my point of view, is extraordinarily attractive. As to buying now, I think the answer is yes. I think you begin buying now. If you are concerned about the possibility of another 10% decline, if that's something that bothers you in the face of what I think will be an extraordinary bull market, perhaps you take half a position, or perhaps you utilize stink bids, which is to say you think about a price that you'd like to buy a stock for, and you offer to purchase it at that price. If it comes down to your price, you're happy. Otherwise, you're probably happy too. But what people need to understand is, although this decline has tested their faith, it's made the stocks more rather than less attractive.
Actually, I'm just going to really drive home that point that you made there on stink bids and starting small. And this comes from a conversation I had with somebody last night. A lot of people are too nervous to dip their toe in a market that's been heavily sold off. Now, you and I both see that as just an opportunity, but people new to the market shy away from that. Pointing out that you can start small is perhaps one of the most powerful things a novice investor can do. You don't need to throw the farm to get started in investing. You can start small. And as you said, throw out a stink bid. I like that term, by the way. I'm going to use that quite a bit. And what you think you would pay for the company, and if the market takes it, the market takes it. So that was very good information there for everybody listening. Now, before we move on to broader commodities in the sector, let's just touch on a little bit in the mid-tier gold space. Now, we might localize it to the Australian mid-tier gold space in the moment, but let's look at the international gold space first. You talk about you seeing a lot of free cash flows and how attractive the mid-tier sector is looking in the North American markets. Can you elaborate a little bit on what you're seeing over there?
In fairness, your market too. The companies that are, if you will, the tier below the biggest and the best, often single asset producers, are being overlooked in this market. The first to move was, of course, the Franco-Nevadas and the Newmonts and the Newcrests and the Barricks. Then, and I've never seen this before, the penny dreadfuls moved. We had to move beginning in sort of, April of the sub 200, even sub $100 million market cap. That isn't the way the market used to work. And it left out the middle of the market, particularly the single asset producers. The single asset producers are rightly perceived as being riskier than the multi-asset producers because they only have a single source of revenue. But what happens in the mid stages of a market is that value-oriented investors come down into the single asset space because of valuation discrepancies. And if they don't, the multi-asset producers take over the single asset producers, because if a multi-asset producer takes over a single asset producer, then the objection to a single source of revenue has disappeared. The other thing that we're seeing is multi-asset companies that have tier 2 deposits, million ounce deposits, or even sub-million ounce deposits, but have, 2 or 3 have composite operations that weren't particularly attractive at, say, $1,100 gold. Those are often, and I'm talking US dollars, of course, wildly attractive at $1,800 gold. The truth is, and I think this is true both of Australian and North American producers, the management teams aren't uniformly or ubiquitously believers in the gold thesis. They're involved in the gold business because it's easy to raise money there. And virtually everybody in the space had their budgets for this year predicated on US $1,200 to $1,400 gold. Many of them are enjoying a very surprising amount of free cash with no plans as to what to do with it. The good side, if there is a good side of having very constrained development or exploration opportunities, is that managers tend to, and investors tend to insist on, interim returns of capital, either by way of increased dividends or increased share buybacks, both of which tend to be very good for market capitalizations. We are seeing companies that are stepping up various forms of exploration and development expenditure and still can't, if this is the right phrase, cope with the increase in unbudgeted cash, which is a problem that the industry hasn't been confronted with for probably 15 years. In the range of problems, probably a very attractive one.
Now, I'm just going to harp on the extra cash thing for a little bit longer, because I was going through some of the company's books, mostly in Australia, but I did touch on Kirkland Lake Gold. They're sitting on something crazy like $800 million in cash, US dollars, I might just point out. Now, that's over $1 billion in Australia. That is obscene. So, I don't think Kirkland's an anomaly. Oh, I'm starting today real well, aren't I? We're seeing a lot of companies with this cash. Now, you're talking about it maybe in the way through of share backs and increased dividends. What are the odds some of these overly cashed up companies are going to start using it to buy out other companies, or at the very least, start spending up big on exploration?
I think they will start spending on exploration, but I don't think they will yet, because you can't ramp up exploration like that. During the 10 years, the 10 bad years that preceded the good year, many companies de-emphasized their exploration to the extent that they even laid off most of their exploration staff. I joke now that the board tells the CEO that he or she must ramp up exploration. They get on the phone to their exploration department and are informed by finance that they laid their exploration department off in 2016, which means that there's no one to talk to. That's a bit of an exaggeration, but you get my point.
Yes, I do.
It normally takes 18 months and about $1 million US, perhaps $1.5 million US, for a North American company to establish a regional exploration department in a new terrain. So if, as an example, an Australian company was going to go to Papua New Guinea or to Chile, it would likely take them 18 months and $1 million or $1.5 million US to put themselves in the position to actually be able to do some exploring. So yes, I expect exploration expenditures to skyrocket over the next 3 years. But the companies, as a consequence of the dearth of exploration activity for the last 5 years, can't spend on exploration right now because they don't have anything to spend it on. Not that it necessarily constrained them in the past, but I think the lessons learned in 2011, 12, 13, 14, 15 with regards to the excessive expenditures that happened in the decade before are fresh enough in management's mind that they aren't going to spend money on nothing for a while. So I suspect that what you're going to see is increased dividends or increased buybacks. I suspect that many of the acquisitions that you see in the next 18 months will be share-based, which isn't necessarily a bad thing. If you have a circumstance where the transaction is a strategic transaction rather than growing merely for the sake of growing, if you have a circumstance where 2 + 2 = 5 as opposed to 4, doing a share-based transaction is a good thing. And I think we're in that virtuous part of the bull market where the next 18 months we'll see more virtuous rather than virtue-less acquisition.
All right, so I think we've covered gold quite well. I want to move on to copper and iron ore. Now, I have consistently called the iron ore market wrong all year. I don't think I've made a decent call on it. Now, the iron ore price is absolutely flying. But also, too, copper, you made a couple of comments on copper, how you have incidentally not called the industrial metals market as correctly as you would have hoped. Can you point out what you thought was going to happen at the start of the year versus what has actually happened in copper and, lean on iron ore?
Well, let me start off by saying you're very polite. My 2020 track record on industrial materials is unblemished by success. I had anticipated a fairly soft economy. I had anticipated, unfortunately, in interviews with you, even in front of this audience, that we needed to unwind a little bit of the economic excess that took place in the recovery post-2008. And we also needed to factor in on the damage done to the global economy by the COVID-19 virus. What I failed to note, I have in common with 4 prior failures, which is to take into account the unbelievable impact, near-term impact of stimulus spending. In the case of iron ore, particularly in China, the Chinese, as an example, spending down their foreign reserves, foreign currency reserves on domestic economic programs, and also engaging in quantitative easing on a level that would embarrass even the Americans. And the impact of that on the iron price and the copper price has been absolutely astonishing. Now, I'm not long iron stocks. I am long some copper stocks because copper has been so good to me in the past. So I'm delighted, Shae, to be wrong, even if I'm embarrassed by it.
I'm going to keep talking to you about copper for one more second and try and, I know, having been at your conferences, both virtually and in person in Vancouver last year, there's a bullish sentiment on copper. Basically, you're surrounded by a lot of analysts who are quite confident in copper, but I don't think that's really translated yet to the retail market. So can you please explain your optimism and why you're so convinced that there are opportunities in copper?
3 reasons. One, big copper mines are hugely and stupidly profitable. And great big copper deposits always give you surprises, and those surprises are almost invariably good. And an old man like me prefers good surprises to bad surprises. You come back from them more easily. In terms of the material itself, long-term, I'm bullish for 2 reasons. Not just the electric vehicle, but rather the electrification of the world. There's still 1.2 billion people worldwide, Shae, that don't have access to electricity, and they'd like it. And increasingly, they're able to afford it. In addition to that, those of us who have access to electricity want to do more things with it. It's integral to our way of life, and copper is integral to that. You don't move watts from place A to place B without copper. And so I see demand for copper, demand for power, the demand for distributed power, which is a fancy way of saying batteries, all growing. And all that is good for copper. I also look at the fact that in terms of supply, most of the supply in the world for copper is, like myself, long of tooth. Deposits that were discovered 40 years ago, put in production 25 years ago. approaching either maximum production or, in fact, depletion, while the new supplies of copper on a global basis seem to require an incentive price north of $3.50 US per pound, a level that we have now breached. If we fall below that, we have a circumstance where, as the old copper mines deplete, the new copper mines aren't brought onto production. And if we see that sort of circumstance, I think we could see a copper price that would truly surprise people because of copper's real true indispensability to the lifestyle that we enjoy today. So I'm extremely bullish the material longer term. I'm bullish the companies and the deposits. I mean, I was bullish on some individual copper companies this year, despite the fact that I wrongly believed the copper price was going lower. That means that I'm fond of that activity. Big copper mines have rewarded me extremely well in my career, and I'm always anxious for more of those rewards.
Once again, I will just point out something that I hope investors take away from your answer there, and that is that patience pays off. You know, copper mines aren't set up in a blink and taken down in a blink. They're a massive multi-decade project. So even though copper has had a bad year price-wise, it's about looking at the long-term trend, not the short-term, feedback that you're getting right now. Now, just quickly, I've got a couple of questions before I run out of time with you today, Rick. Let's talk oil. Nobody would have wanted to touch oil stocks back in March this year when planes stopped flying, we stopped driving. But, there's been a little bit of a rebound in the oil price. Also, too, there is an energy transition underway where, supposedly we're all going to be moving away from combustible engines and moving to electric powered vehicles. Does that mean there is any room in oil stocks? Should investors even be considering them, or is oil a dead duck?
I think oil stocks are indispensable for resource investors. My most important thesis, other than the precious metals thesis being insurance against your government, my other natural resource thesis is that you find a commodity that's essential to the way that we live, that's selling on a global basis at a discount to the cost of production. That means either that the price of the commodity goes up or the way we live our life changes. Greta notwithstanding, peak oil demand probably occurs around 2035. And at oil prices below US $50, oil supplies, at least in their current availability, cease about 2.5 years from now. That isn't to say that oil goes away, but we won't be able to satisfy worldwide demand within 30 months at today's oil price. So with the exception of those 7 or 8 listeners that you have that have Teslas in their garage, for the rest of them, if they believe that 5 years from now, when they leave their bedroom or wherever they are and go to the garage and turn the key to the right, if they believe that the car is going to start, they believe in higher oil prices. It really is as simple as that. Now, I'm going to get a lot of hate mail in the discussion group, maybe not so much from the Australians, but the New Zealanders, the real greenies will hate me for all that. But it kind of doesn't matter, irrespective of your narrative, irrespective of your rhetoric, facts are facts. But will we have an all-electric, non-polluting economy in 25 years? Yeah, probably, especially if you guys abandon your 3 mines policy and we get a lot of nuclear construction, that would help. But on a net present value, what happens 15 years from now doesn't matter. What happens 3 or 4 years from now matters. And commodities that are necessary for the way we live, that are priced below the cost of production, aren't going to be available in 5 years unless the price goes up. Now think about what's more probable. This is fairly simple stuff. The other nice thing about the oil stocks, one of the things really wrong with being Rick Rule and being as patient as I am, is I confuse 2 words in English, inevitable and imminent. If it's logical that it should happen and it's inevitable, I believe it's going to be imminent. And that doesn't seem to happen to me. The beautiful thing about some of the big oil companies is that they pay extremely handsome dividends. And so in this interest rate environment, the time value of money consideration goes away. If you're enjoying a 5% yield in a 50 basis point world, your carry cost, that is to say your cost of capital, is negative, which is extremely pleasant. You get paid to wait. best of all worlds.
On the oil subject, just to rev up the greenies everywhere, I'm a four-wheel driver, and I can absolutely tell you right now, electric battery-powered vehicles don't have the same horsepower equivalent and dirty low-down torque that oil engines do. So I'm not quite sure it will be this utopian future of all of us driving these electric cars. Now, I want to bring it on home. Let's talk Aussies and Aussie stuff. Now, first of all, you've done this a couple of times now, which is talk about your ranking system where people can email through the only commodity stocks that they own, and you rank them. However, one of my subscribers actually did take you up on your offer, and he sent through, his positions, and he actually had sent me this query. He said, I've sent Rick through my holdings. He's come back with a comment on BGL, which is Bellevue Gold. And he said that you like the company, you like the prospects, and you think the prospects are good, but you think you're a bit worried about the shareholders. Now, I had to explain to the subscriber that that's actually you, and very typical of your sense of humor, because Sprott has an interest in Bellevue Gold, don't they?
That's correct. We as Sprott and myself as an individual are very large shareholders. And I was in that circumstance making fun of myself.
Have a bit of fun.
Correct.
I have to say, I loved it. It landed very well with the gentleman in question. But more to the point, let's, for people who are watching for the first time, because not everybody, believe it or not, has heard of you, let's talk about your ranking system and what you're actually offering for people to send through, especially coming into the Christmas period when we've got a bit more time to go over our portfolio. So could you just elaborate what the Sprott ranking system is?
Absolutely. Any of your listeners or subscribers who care are urged to go to a website, sprottusa.com/rankings. You'll find a web form there. And if you enter your natural resource holdings, name and symbol, please, I will, to the best of my ability, personally rank your holdings 1 to 10, 1 being best, 10 being worst. Bear in mind, my rankings are regarded as very harsh by other analysts who I would suggest are very generous. I will comment on individual issues where I think it's appropriate. Obviously, some of my comments, like the Bellevue comment, are a little off base. I will also include, if you mention charts in the request, the 50-year Barron's Gold Mining Index chart, which is the best visualization of gold bull markets and gold equity market performances generally that I have available to me, and a 100-year commodity chart, which will show how cheap other industrial materials are relative to other parts of the economy in relation to the last 100 years. A chart that basically every Australian should have on the cover of their checkbook. It has a lot to do with how things will be in Australia for the next 7 years. Subtext, rosy. And so, to the extent that people hear what I have to say about things, and people normally do at year end, people take stock, bad pun, they take stock of what they've done over the last year and make plans for the year ahead. And having an impartial third-party assessment of what you've done and why is probably a good thing. So I look forward to doing that. I should say, for those of your subscribers who don't know, both I personally and Sprott as a group have a long history in Australia. My own as an investor goes back to the decade of the 70s, before some of your listeners were born. And our participation as a group in Australian equities markets goes back at least to 1990, to the early diggers and dealers.
Ooh.
Oh, fun. It was fun.
Well, that's actually a perfect lead in for my next question, because I'm hearing whispers that you are putting down roots in the Australian market. Now, does that mean that you are going to be joining the rest of Hollywood and moving out to Byron Bay, or is it more you're heading towards the Pilbara?
I'm more comfortable probably in Kalgoorlie than Byron Bay personally. I have other avenues for my other appetites. I don't need to come to Australia for that. But in truth, we've had roots in Australia for a very long time. Australians are overrepresented in terms of Sprott's intellectual capital, be they financial analysts, all those things. But the most important thing that we're doing in Australia in the very near term is we are launching, in conjunction with a financial manager in Australia, Evans Dixon, a Sprott managed gold equity mutual fund. So in addition to investing in Australia, we will begin to invest for Australians in a global market. I think we have a couple unique talents which Australians will like. The first is that one of the attributes that some Australian companies have over other is access to global capital. We're uniquely placed to understand that because we are global capital. We understand how to access our markets, and we can segregate among Australian issuers by those who are well regarded and understand the capital markets game in Great Britain or the United States relative to others. But we also, I think, have a unique ability to help Australians internationalize their precious metals and resource portfolios, best of breed, whether or not they're South African, British, Canadian, American, or Australian. So in both of those contexts, I think that we have the ability to help some Australian investors who care about precious metals.
Well, I look forward to hearing more about that and how your influence in Australia lands. I'm sure many Australians are actually going to be looking forward to it. Rick, unfortunately, I think I've taken up too much of your time today, so we'll probably have to leave it there. Once again, thank you very much for joining me in what is our last interview for 2020, I believe.
Shae, it's always a pleasure. I look forward to renewing the process in 2021.
I'll speak with you next year. Thanks, Rick.
Thank you.